A company with assets totaling $250 billion could easily ascend to the pinnacle of its industry on the global stage, right? But China's real estate titan, Country Garden, failed to make an interest payment of $15.4 million within the allotted 30-day grace period. Though a modest sum compared to its assets, failure to procure these funds would cascade Country Garden's entire $15 billion foreign debt into cross-default, leading to an instantaneous credit rating downgrade. This would subsequently bar the company from securing any funds from the US dollar market. Astonishingly, Country Garden could not muster the funds. This glaring inability to pay off a small debt speaks volumes about Country Garden's financial predicament. One might wonder, doesn't Country Garden boast $250 billion in assets? Surely a $15 billion foreign debt shouldn't pose such a huge issue. Yet Country Garden's US debt is merely the tip of the proverbial iceberg. Contractual liabilities of Country Garden stand at a staggering $700 billion, primarily from advanced payments by homebuyers for future constructions. Outstanding accounts payable amount to $40 billion, mostly owed to contractors and suppliers. Cumulatively, Country Garden's immediate financial commitments amount to $110 billion. Which begs the question, where did the money go? Country Garden's Forest City project in Johor, Malaysia is a case of drastic losses. Located just 2 kilometers from Singapore, the project was jointly promoted by Country Garden's chairman Yang Guoqiang and the chief minister of Johor. However, the tables turned in 2018 when the chief minister's political adversary became Malaysia's prime minister, leading to the abrupt halting of the project. At this juncture, having been on sale for just 2 years, Forest City garnered a revenue of around $4 billion against an initial investment of $34 billion. By 2018, losses were pegged at $30 billion. Factoring in a 5% loan interest, the project's accumulated losses now stand at $38 billion. Facing the unfavorable trajectory of the Forest City venture, Country Garden hoped that business expansion would bolster profits to offset past deficits. Regrettably, in this expansion bid, the company, which used to be strict in selecting land parcels, became lax. It began choosing even low-profit endeavors, which further exacerbated debt pressures. To put it into perspective, before the Forest City project's launch, Country Garden's total debt was a mere $37 billion. Within the second year post-launch, this skyrocketed to $68 billion, touched $120 billion in the third year, and stands at $160 billion currently. From 2018 to now, Country Garden's net profit has been $17.5 billion. $5.5 billion has been distributed as shareholder dividends, leaving just $12 billion. Even if this entire amount was dedicated to settling debts, it wouldn't even begin to address the $38 billion deficit of the Forest City project, let alone other debts. Country Garden had been pinning hopes on a post-pandemic 2023 rebound in the real estate market. However, the bursting of China's property bubble has dampened these aspirations. They've struggled to offload properties in third and fourth tier cities. This culminated in a reported revenue of only $200 billion in the first half of the year, coupled with a declared loss of $7 billion over the same period. In the latter half of this year, Country Garden's property sales in July amounted to a mere $1.6 billion, dwindling further to $1.4 billion in August and plummeted to just $840 million by September. Experts are projecting that the real estate giant's total sales for the entire year won't surpass $27 billion, which is significantly less than half of last year's figure. Confronted with this drastic downturn, the Yang family at the helm of Country Garden recognized the looming crisis. However, instead of addressing their mounting debts, they shifted their focus to asset transfer. Major shareholders of Country Garden cashed out $5 billion and subsequently lent this sum back to the company. Those who were once key stakeholders have now positioned themselves as creditors, insinuating that in the event of any future liquidation, this debt would need to be settled, potentially repaying the Yang family. Moreover, Country Garden has donated shares worth $5.9 billion to the Guoqiang Public Welfare Fund. ensuring that these shares remain untouchable in any future restructuring or acquisitions. These strategic moves seem to signal the company's preparation for a potential winding up. Over the summer, senior executives of Country Garden began transferring their assets and resigning from the company. Subsequently, major capital institutions adopted a cautious stance towards the property titan, withholding further investments. In addition, the company's credit rating has consistently deteriorated. Last year, global rating agency Standard & Poor's downgraded Country Garden from BB+ to BB. Shortly after, Moody's followed suit, demoting it from Ba3 to B1, which falls under junk or non-investment grade. In layman's terms, the global financial community is signaling to its investors to steer clear of Country Garden's debt. Its stock price, once at 17 Hong Kong dollars in 2018, has shockingly plummeted to 0.69 Hong Kong dollars. The walls seem to be closing in on Country Garden, leaving it in an almost insurmountable predicament. Across the nation, Country Garden has 3,179 unfinished projects to complete, which translates to just under 2 million housing units according to statistics from the beginning of the year. Last year, Country Garden spent $13.5 billion and delivered 700,000 units. This year, they aimed to deliver another 700,000 units, a target which seemed achievable. This would suggest similar delivery targets over the next 2 years. With peak delivery expected between 2023 to 2025, the company could be shelling out more than $13.5 billion annually. Given this backdrop, analysts estimate that, to maintain a balance of income and expenditure, Country Garden would need monthly sales of $2.7 billion. However, currently monthly sales have shrunk to $800 million and show signs of further decline, making it challenging for the company to secure considerable sales returns. To fulfill its incomplete projects, Country Garden will likely need to raise even more funds. There are rumors that the company's founder, Yang, personally visited Beijing to discuss the possibility of state-owned enterprises injecting capital into Country Garden. By mid-year, Country Garden's cash and cash equivalents dwindled to about $13.6 billion, insufficient to cover its short-term interest-bearing liabilities of $16.2 billion. Currently, Country Garden is in talks with foreign creditors regarding debt restructuring, aiming primarily to negotiate deferred payments. Publicly, Country Garden has 15 US dollar debts totaling around $9.3 billion. Of these, 2 bonds amounting to $1.5 billion will mature in 2024, 8 will mature between 2025 to 2026, and 5 between 2027 to 2031. There are also 7 other non-public privately raised debts, which could be in other currencies or forms. All in all, offshore loans and bonds are unlikely to exceed $15 billion. These debts will most likely be postponed, as liquidating Country Garden currently presents challenges for overseas creditors. Country Garden's only foreign project, the Forest City in Malaysia, has been halted for years and isn't considered to have significant value. In domestic debt developments, in September, the central government slightly eased policies such as reducing housing purchase restrictions in first-tier cities and existing home loan interest rates. Seizing this opportunity, Country Garden negotiated with its 9 domestic debt holdings, successfully rolling over debts valued at $20 billion USD. It's evident that Country Garden is more inclined to seek capital injection from state-owned enterprises and undergo debt restructuring rather than liquidate its premium assets. If they were to sell their high-quality assets now, potential buyers would likely wait for a price drop. Hence, even though they have alternative solutions available, Country Garden seems reluctant to sell off assets worth $25 billion USD. They seem to be relying on creditors' funds and drawing on people's housing down payments. Regarding housing delivery, Country Garden stated, "While we're currently focused on ensuring housing delivery, the handover of houses in country towns will depend on the marketability of the properties in those areas." This statement is puzzling. What does the marketability of houses have to do with completing construction? Haven't the funds for these houses already been collected by Country Garden? Why would new sales be needed to finance ongoing construction? Such logic, especially when the state is not providing relief funds, leaves the homeowners in these country towns waiting. Out of nearly 2 million housing units Country Garden promised to deliver, half are located in country towns. Rural citizens who emptied their savings for down payments essentially mortgaged 30 years of their future earnings in hopes of owning a house. Now, while local governments have garnered revenues and taxes from land sales and Country Garden has collected payments from homeowners, banks have burdened these citizens with mortgages, effectively indebting them for life. A loan of $1 million USD used to purchase a property that cost $2 million USD to build will amount to a debt of $2 million USD over 30 years. And yet, Country Garden remains unapologetic. Every stakeholder in the real estate chain seems to be able to default without accountability, except for the poor homebuyers who neither can default nor file for personal bankruptcy. Regarding payments to suppliers, Country Garden has commented, "Our on-hand funds can only meet the demands of housing deliveries. Prior payments to suppliers depend on future sales. It's perplexing since homeowners have already paid for these houses. It's as if Country Garden is admitting that the money has been diverted elsewhere." Indeed, funds appear to have been misallocated over the past couple of years. Insiders and high-ranking individuals have likely already divided Country Garden's premium assets. Typically, fundraisers related to leadership and senior management's financial management are prioritized, followed by significant bank loans. But the public remains oblivious, only witnessing superficial signs such as drastic stock and bond price fluctuations, perhaps indicating withdrawals from the stock market for distribution among these elites. Employees might face salary cuts due to company funds being diverted, while suppliers might be left unpaid due to Country Garden's financial shortcomings, clear signs of the company's desperate asset disposal. Simultaneously, the company might sell its high-quality real estate equity, liquidate promissory notes, or transfer overseas assets. These actions might not be entirely covert, and external markets and investors might catch wind of such rumors. Through Country Garden's actions, we can trace the trajectory of the crisis facing Chinese real estate firms. In the initial stages of the crisis, companies scramble, seeking governmental aid and communicating with their top brass to safeguard high-quality assets. Subsequently, negative rumors about the company emerge, culminating in bond defaults and substantial losses. When a firm's primary stated objective becomes something as fundamental as ensuring project delivery, as Country Garden has claimed, it signifies a last-ditch effort with its core operations like land acquisition, development, and sales essentially defunct, with the sole focus being on the completion of existing projects. The next anticipated step for Country Garden is bankruptcy. The decline in China's property market has ignited a domino effect on once thriving upstream industries like steel, cement, glass manufacturing, and architectural design. Thousands of companies have gone under, with workers laid off and production costs plummeting. Downstream sectors, including home appliances and furniture, also face stagnant sales. The real estate sector once provided robust tax revenue for local governments, serving as a primary income source. Now, with a drastic drop in these revenues, many local governments are grappling with financial strain, even resorting to salary cuts or layoffs for public servants. As China's real estate bubble bursts, asset values plummet, consumer confidence is shattered, and deeper economic downturn looms. A financial crisis seems inevitable. When multiple real estate giants are ensnared, can the Chinese Communist Party manage the wave of bad debts from these companies? Even if it wanted to, the sheer magnitude of funds reaching hundreds of trillions make it nearly impossible. If President Xi Jinping allows the real estate market to deteriorate unchecked, it will eventually reveal bad debts implicating local and central governments and elites at various levels. Many have exploited the housing industry for personal gain, plunging ordinary Chinese citizens deeper into debt. Essentially, it's a massive wealth extraction process facilitated by the communist government, where the elite benefit substantially. Should this come to light, rage against the Chinese Communist Party could sweep across China. So, what's the solution? Some critics argue that holding the elites accountable for unlawfully seizing public wealth might be the answer. They believe that only by comprehensively reclaiming this illicitly acquired wealth can China's economy potentially return to stability. Yet China's crisis isn't merely economic. It spans political, economic, social, and even moral spheres. With wealth and power so intertwined, would reclaiming the ill-gotten gains ensure that such a situation won't recur in the future?